Well, I don't think all the Fed's rate hikes from the dot plot chart are priced in, but I think the Fed will actually back off. I don't think they'll raise short-term rates to over 3%, which would be a real rate above 1%. That seems quite unlikely, and more market strategists and economic forecasters are now saying, well, perhaps there'll only be one rate hike in December and one more in March. And that's close to my own view. I think we'll see the Fed turn more dovish, and that in turn, of course, will provide quite strong support to financial markets in 2019 that's been lacking, of course, in 2018. My inflation forecast is it'll stay close to 2% in spite of the relatively strong growth and wages picking up a little bit. One reason for that is the very material drop in oil prices that we've seen over the last few months. That's definitely good for oil-consuming countries. It's good for inflation and persuading the central banks not to be too hawkish. So that's definitely something which I think is going to be a tailwind for economies and for investors in 2019. The most important thing to be clear about with the oil price is that the recent changes have been due more to global supply, to the OPEC countries and Russia having increased their output, and under strong exhortation from President Trump, they've kept that output fairly high, and at the same time the US hasn't pressed Iran on oil sanctions as much as was originally feared. And I think it was that sanctions fear that was keeping the oil price so high that led to the increases earlier this year. So I think now is reassuring. The US is not going to seek Iranian oil exports dropping to zero. It's announced waivers for 8 of the larger consumers, and that means a more benign outlook for the oil price, and that's important obviously for headline CPI inflation.